Good morning, Sunny. How are you doing this morning?
Good morning, Ravi. I'm doing great. How are you?
I'm very well. Thank you very much for agreeing to join me on this web recording or Zoom recording as it is now, talking about how to manage a company through dark times, through a recession. You've been a great friend of Shasta and myself for many years. We at Shasta Ventures, just a quick introduction, are an early stage venture capital firm. We help companies that have built a product, have gotten a couple of customers, help them scale their go-to-market to 10 million, what we call as milestone one, which is 10 million of ARR doubling. And that puts them in position to attract money from the later stage investors. And that's our role in the venture ecosystem. We've helped many companies through that journey, most notably Sunny's company Apptio, which we'll talk mostly about, as well as other companies like Zora and Anaplan, all multi-$100 million revenue companies. I've had the good fortune to know Sunny Gupta now coming up on, I think it's 13 years or 14 years where I met him. And he's been one of the people that I've learned a great deal from and have really he has helped make my career and indirectly helped make Shasta Ventures as successful as it is today. Sunny, I first met him when he was the founder and CEO of iConclude. He ended up selling that company to Opsware for $60 million. And then he joined Opsware and quickly became their COO, and then quickly left Opsware when Opsware sold itself to HP for $1.5 billion to found Apptio. And he picked an interesting time to found Apptio. He founded Apptio in November of 2007 and had to build Apptio and grow Apptio through the last great financial crisis and economic crisis that America and the world has had to live through in 2008. He successfully built Apptio into a multi-$100 million company. It's over $300 million in revenue today, spinning off a ton of cash. And but through that journey, he was able to take Apptio public, which he did in 2017, actually 16, and then ended up selling it to Vista Equity for $2 billion in 2019. I was fortunate enough, and Shasta was, to be an investor in Apptio, and I was lucky enough to serve on the board for a couple of years. So that's Sunny, dynamic individual who we're lucky to get to know. The reason why we chose Sunny as the person that we knew that would be best equipped to help talk to the ecosystem about how to manage a smaller company during this financial times is, one, he's done it before with Apptio. But more importantly, Apptio sells to products and services to the CIO. And Sunny's customers are the people making all the spending decisions that all the companies that we back or that you might have to go through. And he has been continually talking with them over the last few weeks and years, and will have a unique perspective as to how they think about spending money and planning on spending money during this recession. So welcome, Sunny. Sorry for the long introduction, but you deserve it.
Thanks so much, Ravi. That's super kind, and I really appreciate. And it's great to be able to kind of have this conversation and share some of our journey and kind of some of the trends we are seeing.
Okay. Well, the biggest thing is we're living in a time of economic uncertainty, of unprecedented, and I don't think any of us have experienced that during our lifetimes. The main thing, the key question is what's happening to budgets, both in, what's happened to them over the last quarter or two, and what is going to happen to them over the next 6 months for 2020? Does the outlook change for 2021? What's going on there?
Yeah, so Ravi, I would say let's kind of maybe just take a step back and say,
Sure.
I think certainly from our perspective, technology today is powering almost every major business process in the enterprise. We're in a digital economy, and if you go back to starting of 2020, the technology budgets on a global level were expected to rise, call it kind of 4%. But that's not a very accurate statement because many companies were going to be spending much more disproportionately on technology as they were kind of driving digital first strategies. But generally, I think technology And there was a lot of technology spend kind of happening in the business units as well, which may not be part of the overall technology spending.
And this was all new projects and innovation, correct?
All new projects, new digital projects, new leveraging cloud infrastructure, new agile teams kind of springing up, and many of them are actually not even inside the CIO's control. They're in the business units. Then you also have a lot of like SaaS spending, which is kind of rising at a pretty unprecedented rate. So then what happens is COVID hits, right, in kind of call it March. And as a result, I've talked to probably 200 plus CIOs over the last 3 months plus, many of our customers, some prospects. And I would say, it's certainly some industries like hospitality, entertainment, travel have been hit kind of much harder, but generally we've seen a decline in the IT budget. I think the challenge is you got the top lines disappearing at a pretty fast rate in every vertical, including technology vertical, which is one of the most healthy verticals during this time. And so as a result, the CIOs are being asked to replan and reforecast their technology budgets, sometimes 3 to 4 to 5 times within the same kind of timeline. So overall, we've seen in certain industries, sometimes budget cuts as much as 30-35%, the industries which have been hit pretty hard. Then we've seen other majority of the companies kind of creating optionality around 10% budget cuts. But when you blend it all together, our view is the technology budget for this year may be on an aggregated basis kind of down by 2 to 3 to 4% overall when you blend it all kind of together. So, that's a pretty significant, when you think about, close to $4 trillion plus being spent on technology, that's a pretty significant reduction in what's going to be spent on technology, especially in 2020. And I think the key is a lot of these CIOs are preserving the optionality, if you will. They want the optionality because the business impact, while Q2 may be more clearer to these organizations, Q3 may be clearer, but it's very hard to forecast what the impact of Q4 or Q1, Q2 is going to be. So all of these people are being asked to preserve more optionality in their budgets.
Okay. And by optionality, you mean, so before we get into the optionality question, one thing about the overall amount of spend that we talked about is one thing I learned at Apptio, one of the many things, was that IT leaders have a run the business IT budget, which actually is all the initiatives that actually have to stay alive for the business to actually function. And then there's the budgets to change the business, which are innovation projects. Digital transformation would fall into change the business. So when we talk about IT budgets coming down by 4%, what's the ratio of run the business and change the business roughly in terms of IT budgets?
Yeah, that's really, really interesting question. So typically, if you take a look at a typical IT budget, the split between running and change tends to be, these are just broad level ratios, right? 60 to 70% it's spent on running. So that's running my operations, software licenses, maintenance, data centers, cloud services, those type of things. And then my 30-40% is kind of new innovation, right? So if you really think about, it's a very small pie already on new innovation, which was starting to really grow pre-COVID environment. So what we've seen is a drastic shift towards obviously supporting the end user environment. Because every workforce is a remote workforce, so increased spend in desktop, in laptops, and remote workforce, mobility, collaboration, security, those things we've seen high. So people are using this word business continuity quite a bit. CIOs are using business continuity. So when you really drill into business continuity, it really ties strictly to run the budget. So the first thing which is going to get priority is my existing systems, my VPNs, my all the network gear I need to kind of support a remote workforce have to keep operating. So let's kind of make sure we make some investments. And there are definitely increased investments taking place on that part of the budget. The second thing, which is what we are seeing, is we are seeing a smaller shift on the change the business. So that budget is coming down drastically. Now, what's getting prioritized in that change the business is very mission critical digital transformation projects, which companies feel like in this time, I want to, and we should talk about this part too. Like certain companies and CIOs are saying, okay, and CEOs are saying, hey, I want to use this COVID time to actually accelerate my digital transformation, but it's for very mission critical projects which are revenue producing and also have extremely high and quick ROI. So I think it's a massive drastic shift down from the net new digital. So that like a CIO could go experiment with a startup technology to kind of play with some technology on the side, or for that matter, any other company's software, and that's not going to get funded in this environment. So it's a
Okay.
big, massive shift, I would say, as a result.
So one of the things is you could say that, you have a pie, 100%, 60 to 70%, let's say, is run the business. That's staying the same. I had 30 to 40% of change the business. I now have a new expense that I didn't think about, which was business continuity, which is mobility, et cetera. So that might scoop up, let's say, 5% of
Yeah,
spend. So
yeah,
now I'm at 65 to 75%, but then I got to cut 5%. Okay.
yeah,
So now I've actually taken 10% out of the change the business.
yeah,
Okay. 30 to 40%. And then within that, they might have the budget, but they don't want to spend it until they have, because there's one is having the budget, and then it's what am I committed to spending, correct?
yeah.
So they don't want to spend it until later, correct?
Yeah, the other concept, Ravi, as you know, our customers use very consistently is fixed and a variable spend structure, right? What is
Mm-hmm.
my fixed structure? What is my variable cost structures? Variable cost structures are more consumption driven and kind of more easier to impact. So I think when you really think about what you just said, like where do you free up the capital to be able to reinvest in business continuity and user workforce and all, right? A lot of that is coming at the expense of kind of obviously cutting down the change projects, but also I think we've seen this quite a bit through our analytics, like people are cutting down vendor spend too. So many of your companies probably do business with enterprises. So every renewal is under pressure.
Okay.
So some even mission critical software, people are just saying, hey, I'm just going to approach you and just say, hey, give me just 10%
Yeah.
because of COVID, just because
Yeah.
it's COVID, and you have to play ball with that, in my opinion. Otherwise, I think you could kind of create a further risk on the company. And the second situation is they're looking at kind of non-critical kind of vendor and suppliers, and obviously they have a lot of leverage with the large vendors. So I think those companies in a lot of ways will continue to become even more strategic. I do believe in our community, certainly emerging companies will come under even more pressure in this time on the renewal side of the house too, because that capital needs to be kind of freed up for the business continuity and contingency planning.
Okay. That's excellent. So, I think the takeaways for me from this is, one is innovation budgets are under a lot of threat. Most of the money that's being spent on innovation, unless it's mission critical for digital transformation, is not going to be spent. And regardless of where they're going to spend money on new projects, even if it's mission critical, they're going to try to delay the spend, as well as they might delay the decision as well as the spend as long as they can, because they want to retain optionality.
Yes.
So even if it's a massive digital transformation project, they may say, okay, we're committed to doing this. We'll staff it with resources, but let's do a POC and let's start there and limit how much I need to spend. And once we move through this success gate, then we'll commit to another spend. And instead of going from there to an enterprise license right away, we would go in a stair-step way out in terms of a rollout. Does that seem like it makes sense?
Yeah, that makes complete sense. The other thing I would add is I'm sure your companies are seeing this, but the focus on ROI in this environment, and certainly I think we saw the same dynamic in the 2008, 2009 crisis. We'll see kind of how this one, like history will tell us like how this compares to that one. But frankly, the focus on short-term value to the customer, hard ROI, is so critical during this time. Nobody's really got time in this environment to experiment with long-term ROI and soft ROI kind of metrics. That's just going to be a very, very hard sell during these times, unless it's mission critical towards business continuity or towards a digital kind of transformation type of thing. So any company which can prove out that ROI, more focus on the ROI. And so I had this question in front of 200 CIOs, like in this environment, if a vendor is selling to you, when should we bring out ROI as a sales person? Because I have 200 sales reps, so I'm trying to teach them like, and they said in the first minute. Because the ROI is so focused, and this better not be a soft ROI. It's hard ROI. And also some of the advice we got is like, hey, as companies think about kind of commercial models of how you engage, is there some kind of skin in the game vendors can put which are tied to ROI? And frankly, I know Apptio is certainly experimenting around those offers during this time. And we've actually gotten some very good short-term success with that kind of style of a value proposition. And I do think that helps us build these customers for the long term.
Correct. So you're going to go into partnership with them potentially around maybe a percentage of savings. And, just because you're focused so much on how to see, your product focuses on where does a company spend money on technology? What are they planning to spend? What are they forecasting to spend? And what are they actually spending? What's committed? What's uncommitted? To me, I think the key thing here is anything that's uncommitted is under the most scrutiny. Right. Anything that so that to me is like, that's everything. It's like they're going to hold on to that forever. Yeah. And, I used to always have this joke, after the bubble collapsed, there used to be a final meeting. Like, so even after a deal got approved, there would be one more meeting where the CIO or somebody would say, do you actually have to have this? And then if you didn't, the company would never get the deal, even though they thought they were going to get the deal until then. But now I think it's a final cube meeting, or just at a different level. Okay. I think we covered a lot about the environment. The only thing is, do you see anything different between 2008 and 10 and now? Is there any difference in how customers are reacting, or is it a similar? Is it the same?
I think, I think obviously Apptio was a much smaller company at that time versus kind of what we are seeing today. I have a broader access to a style of a customer. To me, this situation feels like just a lot more broader. So every geography, every region, every enterprise, every employee, right? We're all going through the same experience in any part of the world. So, and every industry has some level of impact. I think 2008, I felt like, at least I think there was definitely a crisis, which in a lot of ways was driven by the financial services industry. So I think it was more kind of vertical dependent. So there are a lot of common characteristics, but this one to me feels like more even broad-based relative to kind of what I remember from 2008. The one thing I wanted to also mention, I think you talked a little bit about where are people spending their time, right? So, So the other false positive, I think, which many of us are getting, the CIOs, like I've been able to get more CIOs virtually in the last 2 to 3 months than I ever have, even though we
really?
CIO. Yeah. I've been able to talk to like so many CIOs, like nonstop, like these big dogs, like of, Fortune 100 companies, Fortune 200 companies. And we did a virtual conference. We used to get, 50, 60 people, like we had 290 people. So we're getting a lot of people to engage. So that's the good sign, but it's a false positive too. That doesn't necessarily, so some of your companies may feel like, hey, my top of the funnel looks really, really good in this time. There's a lot of interest, a lot of inquiries, but that's a false positive, because the buying itself is, they may be spending time on learning and so forth and collaborating. But in terms of kind of the actual buying and the conversions of that pipeline is something I think I would put a lot of scrutiny on.
Okay. And you probably have better luck getting people to spend even their time with you, because you're really around directly managing their budget and expense, and they're looking for insights because they're being hammered by the CEO for how are you going to save me money? And so they're looking for anything they can do to solve that question. And that might not necessarily meaning buying Apptio stuff. It's just meaning to get an idea from you that they can go and implement outside of Apptio.
Yeah, they just want to hear best practices. They want to collaborate. They're spending more time on collaboration with each other, leaning on each other. Certainly, the CIO community is kind of something I've seen. And then, I also think, just like you were saying in the approval process, I think the CFOs are, CFOs are going to play a much important role. So what you may think is a 50K deal or a 100K deal, which could get approved by a CIO or kind of, and let's say one of your companies is working with CIO -2 for a deal, and they've gotten confirmation that may happen. But so first they have to go to the CIO, and the CIO may still approve it. But I think, but there are more gates behind the scenes. Even small spend is just under a lot more pressure than what we've ever seen.
So the lesson is uncommitted spend, i.e. I haven't signed a contract yet, is going to be under, is whatever you thought your sales cycle was, add in 2 more meetings after it, okay, at the minimum, in terms of getting people signed off. And in committed spend, i.e. renewals, which is somewhat, expect people to ask you for a discount.
Yes, correct.
So, you guys are a big company, multi-$100 million worth of revenue, strong balance sheet, generating cash, good position. Many of the companies that we're involved in, and many of the people that'll watch this, they're in different stages of growth. So let's look at, and you've been through all those stages of growth. So if you were right now running a company between, let's say, $3 to $10 million worth of ARR, 3 to 10, somewhere in that range. You've got cash for 2 years, okay? Your net burn, based upon a modest plan, okay? You've done, obviously, given that where we are now, you've done expense management, some trimming expense management and all. So there's not much more you can cut, okay? It's, I have like 3 questions, and you can just take them, and we talked about them in advance. The first one is, what are the must-have assets that you're looking to retain so that when you come out in 2 years, you have a chance to grow again? How would you think about that?
Yeah, so I think you kind of said it a little bit. I would say, so let's focus on this $3 to $10 million ARR company. The best news, I think, is if you have cash and if you're funded. So I think the most important thing is bringing the burn down, just bringing the burn down to be able to survive the situation, because the reality is we're going to get out of this thing, and companies have an opportunity to get actually really, really strong in this time, in my opinion. And that was definitely the Apptio story in 2008. I think we were fortunate enough not to be kind of scaling our go-to-market engine, and we kept our burn down to be if you remember our entire OpEx, we were very early in our journey, so that kind of helped us, but we were not burning more than a couple of $1 million or $1 million, couple of $1 million, and we had a lot of money on our balance sheet. So that is probably, it's so important. But in terms of what you would preserve, my personal perspective would be, especially in a company at that stage, it's innovation driven. So I would probably use the opportunity to see anything you can accelerate with your top engineers, because these top companies like Google's and AWS's and Microsoft's of the world are coming after top talent in this time. And we've certainly seen that. So I would definitely preserve that, make sure you can really use this opportunity to hone down the product market fit, the value proposition of the product. I think if you're a $3 to $10 million company, more than likely you don't have a very big sales force. So if you had plans on having a big sales force, don't have plans on having a big sales force. But make sure take your top. Most of these startups, Ravi, as we know, always have one or two of those alpha salespeople who
Mm-hmm.
kind of define the early successes of these companies.
Mm-hmm.
I would actually double down on those people because those people are not going to get fully commissioned out this year based on the COVID environment. So I would probably make sure I make them whole, lock them up through equity and kind of cash incentives. Those are the areas I would kind of focus on. So core innovation, core product market fit, validation with customers. And that's where I think you can do some interesting commercial deals with the customer, even if you're not getting revenue, but you're getting into some pilots and you can get into a commercial construct 6 months or 9 months from now with the customer, and then kind of retain your top talent. And if you had any doubts on any low performer, mid performer, like even if you just have a doubt in your mind, just get rid of them.
Okay. So number one, get rid of anyone that you have a question about, of any type. Okay. Yeah. And if they're top performers in engineering, maybe even marketing or sales, make sure you retain them because people will come after them, the big companies.
Correct.
And use use your limited cash resources, but also use your equity to reward them and lock them up. Yeah. Focus on innovation. That's great. But really finely tuned around product market fit, hard ROI, and be creative in terms of being able to get a new logo on board in terms of how you structure the deal. Be willing to be creative and take on some risk by structuring a deal where you might not get as much cash now, but if you're successful, you get cash in 2021 when things get better.
Yeah, I think that's a really good point. I think the commercial construct, being creative, getting these customers on board, helping them use your value proposition with even alternative commercial models, I think requires just a lot of creativity. And if you're a $3 to $10 million ARR company, I mean, the CEO directly should be kind of driving a lot of these customer engagements. And actually, it's an opportunity to build these relationships and come out of it really, really strong.
Yep. Well, one question that comes up around resource allocation is, you've got salespeople. They're very good. They're the alphas. There's not many new logos that are going to close. You do need to make them whole. But where should they spend their time? I've heard things, okay, let's go get new logos. And I've heard other people say, forget about new logos. Take some of your best salespeople and put them on your existing customers to cross-sell, upsell, strengthen the relationship so that you don't lose revenue. What are your views about that? What's Apptio doing about that in terms of your scarce resource, which is your best people? Where are they spending their time?
Yeah, that's a really good question. So let's start with the sales because I think that's kind of where this is the most relevant. I mean, I think it's exactly that. What we are seeing is the existing customer pipeline is actually off the charts for us.
Okay.
And that's interesting from my perspective because these are our existing customers and they are spending money and time, and we are a complex sell, right? So you have to build these relationships, but these relationships have been built for a long time. So we are finding now we have different parts of the value proposition. So what we are finding is if I put my best salespeople on these large accounts, they can actually go in, navigate their way through the virtual world, get introductions to other departments or other peers. And that's been probably the most successful strategy. The second thing, which we've actually seen some success in this COVID world, is around peer-to-peer. So we've taken our most successful customers and actually created some even incentives to have them introduce us to some of their peer companies or people in the industry who they know. So that actually is really, really good because it's trusted and tried, and because it's going to be very hard to build the relationships, to take people out for a drink or dinners or be in front of them face to face, especially in these large, complex kind of sales cycles. Those are the things. The third thing, I think we are being more selective. If opportunities are coming up through the digital mechanisms, we are actually triaging those opportunities such that our top people get those opportunities rather than the bottom feeders in the
Okay.
company.
So if there's a strong buy signal because it's inbound, and you feel that it's really scoring high, you're not using round robin anymore. Screw it. Just give it to your best people. Give it to the people that can close the deals, and then worry about the rest. They might not be there depending upon how long the environment lasts.
Yes, exactly. Yeah. And
Okay.
marketing, obviously, on the marketing side, because I think some of your companies may have marketing spends too. Obviously, there's nothing kind of happening from a physical event perspective. So I think kind of I mean, that's kind of some of the transformation we're going through, kind of just reimagining the world in a digital world of selling and digital selling. And I think kind of that's frankly created a tremendous amount of opportunity for optimization from a budget perspective, because marketing spend, I still believe, Ravi, is one of the hardest ones to measure from an ROI. And now is not the time to be spending too much money or resource on non-critical kind of marketing things which are not very digitally driven.
So from the strategic to really tactical in marketing, unfortunately, many of us have to still pay the analysts. And it's a cost of doing business in a sense that they will then evaluate us and then they'll provide a trusted reference potentially. How does a small company navigate that? Are analysts open to creative deals today? Because they still have to make money too, correct?
Yeah, we haven't, we have definitely been reducing our spend overall on that community because, I mean, I want to keep them warm and have them continue kind of writing stuff. I mean, I think you got to pay them like it's just, unfortunately, that's how the model works. But I think just moderating that spend down, I think is going to be really, really important.
Now, now you guys are you guys invented technology business management. You're the category leaders, you're the thought leaders. It's easier for you to do it. With a smaller company that has, let's say, 2 or 3 competitors and maybe even a couple of big guys, established companies in a category, is that just part of their budget that's a must-have that they just have to spend just to even have a shot?
I
In
think
my view, it seems like it is.
I think it is. I think that's the one, like other than digital spending, which is whether it's retargeting ads or LinkedIn or website, virtual events or virtual conferences. Virtual conferences, I'm not even still sold yet, whether
Mm-hmm.
that's going to really drive demand or not. But like other than those mechanisms, analyst category is probably the only area I would spend money on. By the way, the press has been kind of pretty interesting from our perspective too. We've kind of managed to get into, in this time, we've managed to get into 3 articles with Wall Street Journal
Great.
by
So,
pitching some very creative stories. And frankly,
mm-hmm.
that didn't cost us that much money.
Okay.
So if you can bring in, and customers actually want exposure. So if your AR/PR teams can be creative with your customers, people want exposure in this time, and especially I think if it's related to COVID and disruption and the unique value propositions during this time, I think that's another mechanism which is pretty low-hanging fruit.
Got it. Last question on marketing is we've been being very prescriptive, as that's kind
Yeah.
of my approach. Is we've been saying, look, if you better do everything via an ABM right now. Use account-based marketing. Figure out who your personas are. Figure out which verticals they are. Launch an integrated program. Otherwise, you're wasting your time and your money and your efforts. Do you agree with that or disagree with that?
I 100% agree with that approach. I mean, this is gonna, spray and pray is just not the place. I mean, ABM, I mean, a lot of it depends upon obviously your product market fit, and
Mm-hmm.
but every company has certain targets. And by the way, that's exactly what we are doing. So we are oriented around the strategic and the enterprise segment, the top tier customers. We're in fact doubling down, tripling down, even more and more on just ABM researching. So we have some offshoring kind of contracts. So these are some of the areas we are actually investing money in.
Mm-hmm.
We are making sure our contact databases. So let's say we sell to the CIO, the CFO, the head of infrastructure, the head of cloud governance. the head of PMO. So we are making sure the contact databases are curated in this time, right?
Mm-hmm.
And we are making sure the content is very, very targeted. There is a CFO integrated campaign. There is a CIO integrated campaign. Also, I think what offers you put in front of them in this time through the ABM approach is going to be really, really critical. I mean, I'm just telling you, like, there's whatever the value proposition was pre-COVID. Uh,
Got to rework it.
yeah, just you got to rework the messaging. I mean, I have a cost optimization message, but you would think like that would be the same pre-COVID and post-COVID, but post-COVID, I just have to be more pointy. I have to be more specific. I have to speak to the challenges. So I think the positioning work is so critical. And then combined with the ABM approach, the persona work, and de-emphasize certain parts of the value proposition which are not relevant in this time.
Yeah. I think efficiency should be dropped from every single value prop today.
Yes.
It's got to be, how can I save you money? It's either how can I help you get a customer? How can I help you retain a customer better? Or how can I save you cash?
Yes.
I think if it's not one of those three, and why would I spend any time with you?
Yeah. Or fourth, maybe just around security or something. You're going to be
security. Yes.
Yeah,
yes.
You're
Security.
going to be screwed with your remote workforce,
Yep.
right? And those type of things. Yep.
Yeah, we're unfortunately not investors in Zoom. I wish I was. Yeah.
Oh yeah.
that would be great. You know. If you were, it's kind of an obvious answer, but there are a bunch of unicorns out there. Not in unicorn meaning the billion-dollar valuation, $750 million valuation. They've got hundreds of millions of dollars on their balance sheet. What advice would you give to a CEO who north of $30 million of ARR, growth is slowing down, and they've got a big balance sheet and they've got a big burn? And they're worried about culture, about cutting back and retaining their cultural asset, about through this period. They still believe that they can grow their business. What would you tell them?
Well, I mean, answer is very obvious on this one. I mean, you got to cut the burn. You're in an incredible situation. And I know during this phase, I've gone through it on our own. In the Apptio journey, I think the amount of money you can spend on experimental innovations, like we all have technical debt as an example. I'll give an example, like and sometimes we tend to fund those type of things, right? To kind of like I would actually look at that type of situation drastically, cut that spend down. Number two, I think sales and marketing. Like this is not the time to be drastically scaling your sales and marketing engine unless you're just getting some exceptional talent or unless you have a certain geographic expansion play. So in our case, let's say we were on the fence to kind of go to Japan as an example, open up Japan. So I ended up cutting quite a lot of my expense out of my overall sales engine, but I did still make a very targeted investment in Japan. And that's still early days, but we're starting to get some very early results. So I would say, no, I mean, you gotta cut that burn down. I mean, you are in such a incredible position with great balance sheet growth, and this is a matter of just time. This is 3 months, 6 months, 9 months. This will pass, and that opportunity will always be there. In fact, strengthen the value proposition with the customers. I mean, the reality is that the demand is just not going to be there for that drastic scale. And you don't want to be making those capital mistakes during this time because the capital could be more constrained 1 or 2 years from now.
You had an interesting, because you are not only growing, but you're also generating a lot of cash. And as your plan, because you started the year with expectations and that changed, you had an interesting metric for every, you told me that, like, for every dollar that you replanned down, what did you do with expense?
Yeah, so one of the fortunate parts of kind of working with Vista Equity, which reminds me very much of your DNA, Ravi, kind of how we used to work together. We basically, so the way we did the planning, this actually happened in the or second week of March, which was very early, right, in the COVID environment, we stepped back and we said, okay, what is the top line impact on new bookings, even though our Q1 at that time was looking really, really strong. It was looking exceptionally strong, right? So we are thinking, hey, the world is good. Nothing is going to be bad. So we just applied some arbitrary numbers, which basically said, hey, our renewals will take another haircut for X percent, few X percent, because we'll be under price pressures, will be some non-renewals. And we didn't really know all the data at that time. And secondly, we said, hey, new bookings, what if these new bookings are half? And I remember sitting in our management meetings with my CRO, with our sales leaders, with our CFO, and people are like, oh, no way, like, there's no way this is going to be that bad. Like, so anyway, we took that, we applied that over multiple quarters, resulted in probably 10-15% kind of delta in our overall bookings. So we added up all that cash, call it 25-30 million, and then we took down dollar for dollar out of our operating plan. So we're generating 14-15% EBITDA cash perspective, and we're a mid-20s grower. So or we were at mid-20s grower. So now what we did is, so even I'm like, hey, growth rate in this stage is not going to matter because every company is going through the same case. What I got to do is preserve dollar for dollar on my EBITDA, keep the company really, really healthy. So we took a lot of drastic measures in March, and this question around culture always comes up, but these are unprecedented times. These are times of survival. These are times of acceleration of your business and value proposition. If you're sitting on cash, you're a unicorn, you have a great market product fit. 3, 6, 9 months. I mean, there's going to be so much optionality for you to accelerate your business, but just spending money, throwing money at a sales and marketing engine, which is just going to be very challenged. I mean, why? Just take some drastic measures now. You're going to be better off down the road. And I would also say every company, no matter how big or small you are, you got people who, there are performance challenges and so forth in the business. So people should just, people just need to make more faster decisions and move with a lot of urgency on this.
Yeah, I think that the lesson for me listening to you is the key word that I'm taking away is the customer wants optionality. So we should create optionality for ourselves.
Correct.
We don't know when they're going to decide and spend money with us. And so we need to save our money and just make sure we invest in what we believe we can't live without. And that to me is sound advice. It tells me that I need to be tougher on my boards with my companies in terms of really challenging my own assumptions as to who's essential in a company or not. And it's hard. Yeah. We're in the venture business. Now you've seen both venture and private equity. Most of us tend to choose the venture business like the growth elements. We like the positivity around it.
Yeah.
And we need to be, in order to get back to the positivity, we need to take just a much more pragmatic view of the world, a much tougher view of the world, it seems to me, as we help our companies navigate these years for the year forward.
Yeah, I would say, Ravi, we use this word quite a bit with our Vista partners, ruthless prioritization, because I think you also want to look at like how you can get stronger in this time. This is not just a defense play. In my opinion, this is giving us an opportunity for offense because there are so many things companies like us all try to do, right? So this is the time to really actually, as a CEO or a board, like I think we have more say, right, in kind of driving that ruthless prioritization. The second thing I think what I've learned, certainly going private with Vista, is the value of the data. So I think what we are looking at even now religiously on a weekly basis, the pipeline, the conversion, the top of the funnel. Like I can tell you 4 weeks ago, there was like a lot of people running around here saying, oh, top of the funnel is looking so awesome and this is going to be great. And like, but just ruthlessly looking at the data doesn't lie. And so we have established gates of when we are going to accelerate investment.
It's interesting that you say about the data, because companies are running so fast when they're growing, interestingly, many companies have poor data because the systems aren't wired up. One of the advantages of a slowdown in growth is that we can actually wire up our systems and operationalize our business so that we can grow in a much more automated, measured, data-driven manner coming out of this. I'm very much advising companies to invest in that infrastructure because you never have time to do it when you're in hyper.
That's right. That's right. One of the things when you were on my board, we used to talk a lot about, you were like, hey, we got to measure. So let's take a sales organization. Let's say we had, 50 people in our sales organization or 100 people, doesn't really matter. We had sub-regions, right? We had segments like large customers, small customers, and looking at kind of just the ROI. I mean, you can't just look at these metrics in a holistic way. So you have to break down the metric by region, by country, by segment, and by product line, and looking at kind of where the productivity is, because there are some parts of the value proposition which is really working in this environment. Mm-hmm. Existing customers, new customers, and using that as an example of looking at the data for marketing spend, for sales spend. I think and these are kind of really good indicators. And then I think you have optionality to say, hey, I can increase my investments on or rebalance my prioritization. So that's an area. So I'm spending, just so you know, but this is partly the Vista model, and I've gotten more operational as a result of going with Vista, but we are spending probably couple of hours, even collectively with the board on a weekly basis.
Interesting.
And then I'm spending 2 to 3 hours with my team on a weekly basis, just pouring through kind of this style of data, especially I think on the sales and marketing side.
Got it. Makes sense. Any last words of wisdom for our audience, Sunny?
No, I think I think we've covered a lot. I would just say that it's unprecedented, but it's also a unique opportunity to come out stronger as a result of it. I think I would say number one, keeping your balance sheet and the company healthy, preserving your cash optionality is probably the most important thing. And whatever you can do to play, what are the defense plays and what are the offense plays? Because I do think the stronger companies will become stronger and become category giants when all said and done. And so you want to be in that category, not the one which just bled out cash and was never able to kind of play the second innings or the third innings.
Great. Well, thank you so much. Good luck with all your operational meetings. It sounds like you guys are reinventing Apptio as you go along for the future. And thank you once again for your time and mostly your wisdom. Okay.
Thanks so much, Ravi. Thanks so much. Appreciate it.
Bye.